Now, for emerging powerhouses like India, the ongoing US-China trade war brings a unique opportunity. As global businesses look to diversify supply chains, India stands to gain as a manufacturing and export hub. But this silver lining comes with a cloud as well. The real fear is that India could become a dumping ground for Chinese goods. Exporters in China look to offload excess stock that they can't sell to the US, and early signs of that risk are already surfacing. India's trade deficit with China widened to an all-time high of $99.2 billion in the March quarter, driven by a sharp rise in imports of electronics, solar cells and electric batteries. In March alone, imports from China surged 25% year-on-year to $9.7 billion. In contrast, exports to China fell by 14.5% in March to $1.5 billion. And China is now India's second largest trading partner after the US, with two-way trade totaling $127.7 billion. The sharp rise in Chinese imports is raising alarm over increasing dependence on foreign goods, particularly in strategic sectors. Analysts warn that cheaper imports could undercut Indian manufacturers and stall progress under the Make in India initiative. Key sectors like electronics, chemicals and consumer durables are especially vulnerable. The trade imbalance also reflects structural gaps in India's domestic manufacturing capacity, which relies heavily on Chinese components, even for growing exports of electronics and pharma products. The surge in Chinese exports comes as the US imposes steep tariffs on Chinese goods. Experts fear that China may redirect excess supply to markets like India, potentially dumping products at below-cost prices. There's also concern that India could be used as a transit hub to bypass US tariffs in response. Now, in response to this, the Indian government is planning a dedicated monitoring unit to track import patterns and curb such risks. Trade experts caution that without tighter controls, India may see a further 20% rise in Chinese imports this fiscal year.